Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 22nd of June. I'm Daniel Lam, your host for the podcast. It's been a week since the surprisingly hawkish FOMC meeting, and it is time for us to take stock. One of the standout observations is the disconnect between the Fed narrative and the rates market. For example, the US 2-year yield has essentially been unchanged, while the US 10-year yield has been whipsawing between the 3.7% to 3.9% level. In fact, from the technical chart, it seems that 3.9% level does appear to be a very strong resistance level indeed. Now, the flows into US Treasury 2-year and 10-year futures remains in line with previous weeks. So basically, the market is saying that the Fed is done, i.e. investors are not believing that the Fed will deliver 2 more rate hikes this year. And this is one reason why Hong Kong China equities have been performing so poorly this week. The story of rotation away from US equities due to the hawkish Fed has not been catching on yet, because US equities and US technology stocks in particular remain in investors' quote-unquote comfort zone, like I always said. So now the key question is, how long would this last? Let's take a look at the positioning of US equities across long-short funds, retail, mutual funds, systematic funds, and option flows. Overall, the positioning has gone from short back in April and May this year to neutral, with the majority of the positioning increase coming from retail investors lately. Based upon past retail positioning, there is likely to be further room for retail to increase the current level of participation. The institutional investors, such as mutual funds and hedge funds, have been less willing to participate in this rally. They could be upping their participation if we continue to get favorable CPI prints. Now, their current positioning is nowhere nearly as bullish as they were compared to the middle of, say, 2021. Thus, there appears to be still some room to go in this US equities rally. The S&P 500 index may attempt to challenge the key resistance level at 4590 after the index possibly correcting back to the 4200 level. The key driver that may turn against US equities would be a series of data that underperforms the heightened economic expectations in the US. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.